Your biggest risk as an investor is always that you own something that is outside of your circle of competence. Because for all the value diversification has to smooth a return, to reduce volatility, whether that's upside or downside volatility, your biggest risk as an investor is still getting it wrong, and you can't get something right if you don't understand it.
Welcome back to the Teaminvest Wealth Builders podcast and another episode of Wealthy and Wise, our collaboration with Ausbiz. Each week, we step away from the daily market noise and take a closer look at what it really means to invest with discipline and clarity. On Wealthy and Wise, we break down the principles of value investing, exploring the difference between price and value and how to make rational, long-term decisions in any market environment. Our conversations focus on practical frameworks, not jargon, using real companies and real examples to bring these ideas to life. Whether you're a seasoned investor or just starting out, our goal is to help you think like an owner, not a trader, building wealth with patience, structure, and confidence. Thanks for joining us. Let's get started.
Wealthy and Wise is your guide to value investing, powered by Teaminvest.
Hello and welcome to Wealthy and Wise. Well, this week, diversification. It is one of the most repeated pieces of advice in investing. Don't put all your eggs in one basket, spread your risk, own a bit of everything. But what is diversification actually doing? Is it reducing risk or just reducing discomfort? And can you have too much of it? On today's Wealthy and Wise, we'll unpack diversification right from the first principles. We'll look at the difference between market risk, company risk, why finance theory leans so heavily on spreading exposure, and whether concentrated portfolios can, in fact, create better long-term outcomes. We will also answer a viewer question, but first, let's add some value. All right, diversification is often presented as a fix-all. But before we get into how much is enough, we need to understand, what it actually is designed to fix and what risks diversification can actually remove, what it doesn't touch. So there's a lot to get through. Joining me now is Andrew Coleman from Teaminvest and David Sokulsky from Carrara Capital. Welcome to you both, the doctor in this case. So looking forward to this conversation. Andrew, I might just start with you to just really basically explain what diversification is.
Well, really simply, it's just the idea that by holding a large enough number of uncorrelated assets, in other words, stocks or assets that move in different directions given the same news, you can take out all of the idiosyncratic or company-specific or industry-specific risk and be left with a return that tracks the market, hopefully in the direction that you want. So it's sort of just a simple way of spreading and removing risk by holding a large enough bundle of assets.
And David, in your view, I get that, but what is it actually trying to achieve?
Well, I think in finance, it goes back to the 1950s with Markowitz when he talked about mean-variance efficiency. And that's really, are you getting the most return for a certain amount of risk? And that's really what diversification comes down to at the end of the day. And so it's, are we taking excess risk and not getting rewarded for it, or are we taking the risk we need to take to get the reward? So if you look at that, we don't know what the future holds. If we knew what the future holds, then we'd just hold one asset, and that would be the highest returning asset. Given we don't know that, we need to look at our portfolio and say, well, look, we don't know that, so what's the best way of managing risk for a given return target? And that's really what diversification is designed for and what it's meant to do in a portfolio.
Does it reduce volatility or the chance of being, wrong, for lack of a better term?
Well, it can do. And this is where Andrew mentioned the right thing there with the correlation between the underlying assets. If you've got all the same assets in a portfolio, it doesn't matter whether you've got 1 or 50, the portfolio can still be extremely volatile. What you want to look at is the correlation between the various assets within a portfolio, how they work together in negative and positive markets, and then overall how that volatility can be dampened over a medium to longer term.
Yeah, and if you go back to sort of the real basics of it, because I think, David, both you and I have the challenge that having studied this in a lot of detail, we're going to probably use words that the average viewer may get a bit swamped by. So if you think of it in really basic terms, if you held a portfolio of only one item, as you point out, then you take a huge amount of risk on two factors. You take a risk on the factor of the overall economy, is the economy rising or falling? And then you take specific risk around that asset. So if that asset is a stock, it's what's happening in that company. If the asset is a class like real estate, then it's what's happening in the real estate market. If it's Bitcoin, then it's what's happening in the Bitcoin market. On the other side of the spectrum, if you happen to have an infinite amount of money and you could cut that up in infinitely small chunks and own every single thing out there, then by definition, the only risk you'd be taking is the overall economic risk, the overall rise or fall. So really what we're talking about when we talk about diversification is trying to find an optimal point within that spectrum, because clearly owning one asset, if you're right, is great, and if you're wrong, is terrible. And clearly owning an infinite number of assets is impossible unless you had infinite money. So from that point of view, that's also not practical. And as it turns out, when you do that maths, sort of the reality is, in a perfect world, if you could have perfectly uncorrelated assets, and they don't really exist, what we mean by that is assets that move completely independently of each other, then somewhere between 8 and 12 assets would give you a broad enough spread to remove any idiosyncratic risk. Of course, the reality is the world doesn't work with perfectly uncorrelated assets. I mean, we as humans just have reactions to things that are not correlated. And that's where I suppose the art and the science comes in to try and maximize that. From an investor's point of view, though, you've got to ask the question, is it worth doing for your portfolio, and why are you doing it? Because that's probably more important than understanding, the academic basis behind it all.
So what is that?
Well, it really depends on the individual, doesn't it, right? So, I mean, if you are very worried about your ability to pick assets, say you're off the street, you don't know whether you can find what a good business or a bad business is, or a good bond or a bad bond is, then clearly diversification is going to be a very important risk mitigation strategy. On the other hand, if you have a high degree of confidence, and that confidence is not misplaced, we're not like Swedish drivers who 80% of them think they're above average, then your ability to hold, say, your 10 best bets is going to outperform your 11th and 12th best idea. So you've got to make a decision around your own personal circumstance that says whether you can be high conviction enough into a very small number of assets and sleep easy at night, thinking you've got it right, or whether you need to hold a much larger number of assets in order to protect you from a personal point of view, because unfortunately you'll only know if you're right 2, 3, or 4 years down the track.
What do you think of that?
Yeah, look, I broadly agree with that, because it's definitely an individual's perspective that's important. But it's also important when you look at the different markets. And if you're talking about you're assuming that we live in a world, let's say in a listed market, of pretty efficient markets and pretty full information. And if you don't have any excess information over anyone else, then how are you going to earn an excess return? And whereas in the private markets, where you can have information which is particular to you or that business, then you can be a little bit more concentrated. So, and it even comes down to when we look at, very much the richest people in the world have only one asset. Zuckerberg only had Facebook. Elon only had Tesla. He's diversified a bit now. But so from a personal perspective, diversification is also very different to a portfolio perspective. So if we just look at that portfolio perspective, there's 3 things really that I think are important. One is that personal perspective to say, how much volatility am I willing to take? If you're willing to take a lot of volatility, you might just go, look, NVIDIA is the greatest company in the world and it's going to be great for 10 years. I just want to load up on NVIDIA, which is not advice, by the way, in way possible. You might be willing to take a 40% drawdown or a 60% drawdown at times. Whereas if you're not willing to do that, then you need excess diversification and you're more happy with market risk. So I think that's really important. The second thing is, if you are only in one asset class or only in one asset, then you need to be very sure that that's the right one. And we live in a world of excess opportunity. You can be in European financials, or you can be in energy stocks, or you can be in Australian iron ore stocks or gold stocks. And so you're assuming that there's also no other opportunities out there. So I would argue in a world that we're in now, the opportunity set is so large that you actually want to be diversified, not just from a risk mitigation perspective, but from an alpha perspective and a return generation perspective.
Does smoothing returns actually improve long-term outcomes for investors?
The smoothing a return, and this is a little bit of a fallacy sometimes with people when they talk about volatility, because volatility is important depending on your time horizon. If you've got a 1-year time horizon, volatility is crucial because you don't want volatility. you can't sustain a 25% drawdown if you're retiring in 1 year. But if you're retiring in 25, 35 years, you can sustain extra volatility, and hence smoothing out of returns is not that important. So again, it comes down to those personal preferences where what do you want to achieve out of your investment portfolio? For a professional manager, it's really hard sometimes because people want a consistent return every month and they don't want a drawdown. And then they'll swap out of that manager and go into another one because they've had a drawdown, which is really not playing that long-term benefit of the manager or the portfolio. So timing is really important, and you can't really talk about diversification or smoothing or volatility without it.
It's fascinating. So what do you really need to own in your view across asset classes? And we'll get into this a little bit in the next segment, but I'm just thinking, coming from a value investor point of view, we're primarily talking equities with you.
Yeah, and I think if I take it out of the sort of conversation we've been having and take it into just a really personal investor sort of question, I think the answer is diversification is an incredibly lovely concept if you can do it right, but usually it's done very wrong. So what do I mean by that? Your biggest risk as an investor is always that you own something that is outside of your circle of competence. In other words, you own an asset that you think is a good idea where you actually know less than the rest of the world, because that's the asset where you're going to get caught when the tide goes out. If you're a doctor, for example, and you have a deep knowledge of medical stocks, the odds are that something that changes in the medical field is not going to leave you holding the bag of a really, really awful capital killer. But on the other hand, if you're a doctor and you invest for fun in Bitcoin or for fun in Slovenian real estate, the odds are something's going to change in that market that you are not aware of. And the first time you're going to find out about it is when the bottom has fallen out of the market. So from an individual investor's point of view, as opposed to theory, I would argue the most important question about diversification is not are you diversified? It's how much of your portfolio fits within your circle of competence. And given that circle of competence, what's the diversification you can stomach? Now, I've joked before in this program that I'm a bit lazy. I mean that as a joke. I'm clearly a nerd and I enjoy doing the research, right? But I've learnt over time that I can follow somewhere around 30 companies with a lot of detail and maybe another 5 or 6 cursorily. So if all I can follow in a lot of detail is, call it 35 assets, then it would be incredibly stupid for my portfolio to have more than 35 assets. Because by definition, the 36th, 37th, 40th asset that I own, I'm now the mug who's likely to find that the market is taking advantage of me. And so that's the challenge. How much time are you prepared to put into your portfolio to understand the assets? Because for all the value diversification has to smooth a return, to reduce volatility, whether that's upside or downside volatility, your biggest risk as an investor is still getting it wrong. And you can't get something right if you don't understand it.
Yeah, and that's why you can also hire a manager, correct? So when you think about diversification, David, can you be diversified and get across just 3 asset classes, or how do you think about it and put it into practice at Carrara?
So for my fund, diversification is actually critical to how we manage it. And with that, I sort of look at thematics, and we might have AI semiconductors as a thematic. And I sort of look at that and I go, well, if that goes down, or we have a bad night, let's say Nvidia falls and Micron falls, what is that going to do to the rest of the portfolio? How's that going to impact, my South Korean holdings or my Brazilian holdings? And what in my portfolio can offset some of that risk? So I sort of look at every one of the thematics that we add to a portfolio and look at, is it correlated? How's it performing? Are they all performing together? And if so, that's not the way I want to build the portfolio. Or are we having some offsetting risk that goes up when actual equity markets go down? So when US equities sell off and we see an outflow of assets from the US, which is what we've seen, then you see the US dollar fall. So you'll see Canadian dollar rise, you see the Aussie dollar rise, you'll see the euro rise. So we have the scope to actually put them in the portfolio to say, look, we don't want to take that US risk across all of the portfolio. So we'll actually hedge some of that risk out and take opposing views in another asset class. So for us, it's absolutely crucial to have a diversified portfolio so that if equities fall, for instance, we're diversified in other asset classes.
Go ahead.
I was just going to say, David takes a really important point there that's worth sort of touching out, because it's, I think, a little bit of a difference between the way we in industry can often think about diversification versus the average investor at home watching this show. We have a challenge which you don't. And that challenge is really simply, and David, you touched on it before, we have to keep our customers happy. And our customers have a wide variety of needs and desires. You have the advantage at home that you have to keep one customer happy, maybe two, yourself and your partner. So you can be comfortable owning a bucket of assets that you think you know deeply and you're comfortable owning, that perhaps a fund manager, even if they agreed with you, can't own, because to do so takes a business risk for us that you don't. And if I take the extreme example of superannuation, you know, the superannuation performance test that came out a few years ago now, effectively says that for large superannuation funds, anyone regulated by APRA, if you miss the market by more than a small number of basis points, 2 years in a row, you're shut down. So if you were in that super fund shoes, would you ever be prepared to take a non-diversified view, no matter how much conviction you have? Well, it's catastrophic if you get it wrong. If you get it right, you get very little reward because you can't charge a performance fee in superannuation. You just get a few thankful customers. And if you get it wrong, your business ends. So from that point of view, managers have to be, on average, far more diversified than an individual, because A, we've got a group of customers that's very broad, and B, there are risks associated with the regulation that you don't have to take. If I come back to the question, though, that you asked around asset classes and number of assets, I mentioned before that the original work from Markowitz and others said somewhere between 8 and 12 was enough if you were perfectly uncorrelated. No one's perfectly uncorrelated. What we've tended to find in our research is that most people feel comfortable and the benefits from diversification become more marginal once you get to somewhere around 20, if you're talking stocks. So we're just looking at stocks here. So if you own between sort of 20 and 25 stocks in your portfolio, the odds are, unless you've gone into one industry and one industry only, like, you know, you've only bought gold miners, you probably have about the level of diversification that you can stomach as an individual investor. For a fund manager, though, you've got to ask all sorts of other questions around your performance relative to the market, your performance relative to statutes. That makes the game harder. I don't necessarily think it gives better returns.
Right of reply to that.
And no reflection on David, for the record.
No. Look, I think the superannuation analogy is very warranted, where, you know, you could argue that our superannuation funds are not interested in returns or excess returns. They are just worried about market returns. So they're not taking steps to, you know, add excess alpha or add excess return or go into a private, you know, transaction, which can make a lot of money. And, you know, I think that's got an impact on society in Australia, because we've got one of the biggest pools of superannuation, which is not funding any economic growth. Mm-hmm. It's just going into benchmarking of listed equities in a lot of cases. So I think that's the first thing. The second thing is, yeah, like, managers, I think, have two things which can help and hinder. And the hindrance is exactly what Andrew said, that, you know, no one manages for complete and absolute excess returns, because you'll blow your fund up. So you've got to have a handle of risk as well. How each manager handles risk is very different. You know, there's some very successful managers in Australia that might have 40% in one stock. There's other managers that, you know, have a maximum of 5% in one stock. We operate much more on that lower risk scale and on the diversified scale, because we are very conscious of risk-adjusted returns. And again, some people aren't looking at risk-adjusted returns. So I think that's the first thing, that, you know, it depends on what, at the end of the day, you're seeking to achieve, which is really important. The beauty that we have as professional managers is that we can pick from anything around the world, and we can put it in our portfolio if we think it adds value or reduces risk. So, you know, if I think Brazilian equities are going to add value to my investors, I can go and buy Brazilian equities. And at the same time, if I think there's a currency risk, I can hedge out that currency risk. If I think that there's a risk with gold going down, then I'll look at why might gold go down. And gold might go down because the US dollar rallies, or it might go down because US yields increase. So then I can take short positions in the bond market to hedge that out. So the beauty that we have is the range of assets that we can use, and we're not just stuck with a simple playbook. Mm-hmm. Yeah.
That sounds like ultimate diversification. Can you ever have too much?
Absolutely.
Yeah.
Absolutely. I think Andrew was 100% correct with, you know, you can only manage so much, and you've got to have a reason why things are in the portfolio. You know, an ETF that tracks the ASX 200 is essentially a diversified Australian equity portfolio. How you weight it is questionable. You know, the Dow's weighted according to price, and you look at the Australian market, ours is weighted according to market capitalisation. But effectively, that's a fully diversified Australian equity portfolio, which goes up and down. You need to add, I think you need to add returns, which is really what we're all trying to do, either individually or as professionals. You want to add return. And you can't just go and diversify all your risk away. And so to get a little bit complex, if you look at a lot of the quantitative strategies, they're based on factor analysis. And you can run a fantastic quantitative program to break down the return of every stock in the Australian market according to 25 or 30 factors. And if you hedge all those factors out, then you don't get a return.
Yeah.
So yes, you can definitely over diversify. And as I said, really coming back to where we started from, it depends on the level of risk that people are willing to take, and it depends on what return they want, and depends on what their capability is.
Well, fascinating conversation about diversification. David Sokulsky, Carrara Capital, as always, a pleasure to have you in. Andrew Coleman, stick around after the break where we will go head to head. So we've learned a lot about diversification. I have, at least. If diversification reduces certain risks, how much do you actually need? Is holding 40 stocks safer than holding 10? Does owning multiple asset classes genuinely protect you in a downturn? And, in practice, how do we think about diversification within equities toward diversification across asset classes? Andrew Coleman from Teaminvest is here, and joining us now in the studio is Rob Gilmore from Wealth Simplicity. Rob, welcome to the program. Thank you so much for joining us. You must have the conversation with your clients on a daily about building diversification into their portfolios.
Well, yeah, 100%. So when someone comes into our office, we're trying to solve for their personal objectives, where they are at their stage of life, normally preparing for retirement. So, diversification is a very important part of that risk management conversation. And it's not just about risk management at a portfolio level. It's about risk management for a client's long-term objectives and how we solve for, that retirement question.
And so what risks are you actually trying to mitigate with diversification? That's, big market drawdown, that's a change in life circumstances?
Yeah, it's not so much the short-term market volatility. It is those drawdowns that can happen at the worst possible time. So it is known as sequencing risk. And if someone starts to draw on their portfolio, just as they start retirement, and then there's that big market drawdown and they're drawing on their portfolio at the worst possible time, that's a very big risk to be cognizant of. And we manage that through diversification across different asset classes. So we can look at things like liquidity, we can look at things like how assets perform over different stages of the market cycle in order to be able to build a portfolio that is aligned to their objectives.
Mm-hmm. So as a value investor sitting there, Andrew, do you have any want to diversify across asset classes? Because in my experience speaking with you, it is very much equities.
Yeah, I think the challenge is coming back to it is why are we diversifying, right? So if what we're doing with diversification is to reduce the volatility of our portfolio, then you can achieve that in a number of ways. You can do it through spreading across asset classes, you can do it through spreading across geographies, or you can just do it by owning assets in one asset class that move in different directions. And so from that point of view, my argument would be that as a value investor in the Australian market, if you wanted to, you could be fully diversified just owning Australian stocks, provided you were careful which stocks you picked. Now, the question is, are you careful which stocks you pick? And is that something you even want to do? But I think it's important to go back to the beginning. Diversification is the concept of that idea of reducing volatility, removing out individual risk or idiosyncratic risk, the risk associated with a single asset in your portfolio. Now, I would ask the question, why would you want to remove all the volatility from every asset in your portfolio? At that point, there'd be no point owning anything other than an index fund anyway, because if you're going to own only the market return, why go through all the hassle of following companies or following different asset classes to get the market return at the end of the day? That's a lot of effort for exactly the same return. So my assumption is that if you're bothering to understand individual assets, whether that's companies, bonds, property, whatever, you're doing so because you'd like a return better than market average. And the only way you can do that is by ending up concentrating. Because if you own everything in the market, you can't do better than the average of the market. So from that point of view, what should you be looking for? Well, I would argue, and we've talked about this before, that the things you want to look for are the same as a value investor, regardless of your purpose, whether it's diversification, removing volatility, getting higher growth. And that's simply put, finding wonderful businesses available at reasonable prices. And if you want to broaden it beyond stocks, it's wonderful assets at reasonable prices. So, buying an investment property at a good price is likely to give you a good return. Buying an investment property at a bad price, regardless of the suburb, is going to give you a bad return. Okay,
so let's keep it at equities. Would you believe that there are, too many, is there a limit of how many companies you'd want to hold to remain diversified?
Yeah, I think we get stuck with diversification often, right? So that's that idea that if we've got, say, 10 or 15 really good ideas, by diversifying ourselves out into our 25th best idea, we're going to actually reduce our returns because we're now not playing in an area we're comfortable. And I just pulled together a little bit of data then for the viewers, but there's roughly 2,000 companies on the ASX. 75 of those pass our filters of what we would consider to be reasonable companies. That's things like high return on equity achieved with little or no debt, growing earnings with a high degree of stability, and a business that hasn't been mining shareholders but has rather been returning a return to those shareholders. Of those 75 companies, our 700 roughly members around the country have selected on average about 20 to 25 every year for the last 20 odd years. And that's delivered a 16% plus return. Now that's not rocket science. And there's a reason they've done that. It's really simple. It's being selective across a really broad group. Now to me, that still gives you diversification because if you own 20 of something, if you're equally weighted, you've got no more than 5% of your eggs in any one basket. That's pretty diversified. Could you do more diversification? Sure. But what are you giving up?
Mm-hmm. And so when you're speaking with your clients or when new clients come to you, are you looking critically and having a conversation about how diversified they are, even if it's within, just their equity holdings? Because I would imagine a lot of people are very overweight equities.
Look, that does happen. And certainly I do believe in the idea that you can have just diversification for the sake of diversifying. And, a lot of the big public offer funds, they have to own certain assets and they ultimately want to be very benchmark aware. I think when it comes down to investing individual portfolios and investing for your own objectives, there are plenty of sources of great returns outside of the equity market. And so that can act as ballast. It's not about saying, well, we're not after great returns or absolute returns. It's about being open to other opportunities outside the equity market, which, in years gone by, there has been a lot of nervousness by investing in the equity market. And you only need to go back to periods like the GFC or even during COVID, where you do get severe market reactions. And if you don't have a portfolio that's looking at opportunities outside of that space, then you are really beholden to, what's going on in that particular market that is driven by a lot of sentiment. And so I think clients are very aware that if they come in with a portfolio with Australian equities, that there are opportunities to look at returns very conservatively in the fixed income space. And I'm not talking about low return government bonds, or even looking in the private space where I think you can actually get more transparency when you're actually looking into the underlying investment of a company rather than relying on public market information. So I think when it comes down to an Australian equity portfolio, if there are direct equities, there does need to be a very clear system as to why people are invested in particular stocks. And a lot of people will have a lot of CBA and they might think they're great investors because they've had CBA in their portfolio and their returns look good. Now, is that a strategy for the next 5 or 10 years ahead? And that's where expertise around that equity piece is really important. And what Andrew is talking about is having that strategy around how you manage your equity portfolio. What income are you getting? Are you getting sector diversification? That's really, really important. But I don't think it should be at the exclusion of other asset classes as well.
So generally speaking at Teaminvest, how do you build diversification into your high conviction picks?
I think it's just a question of trying to own a portfolio that isn't all in one industry or exposed to all one thing. It's an interesting thing for the average investor. the asset classes that we have available to us, unless we're highly specialized and access to all sorts of weird and wacky products, are really cash, which has generated on average a return below inflation, government fixed income, which has been about inflation, corporate fixed income, which has been about 5 to 6% per annum in the long term, and equity markets. And pretty much whether you pick the Australian equity market, the US, the European, Asian, you've got somewhere between 7 and 9% per annum for the long term. So I would say, as an investor who can access general things and you can see it for the long term, so you're a long-term investor, the equity market has delivered you by far the best return. Now, it comes with the most volatility, and it comes with the most volatility because companies can go up and down. A fixed income, by definition, is fixed. It has two states. It's either paying you its coupon or it's not paying you anything and the debt's worthless. So from that point of view, there's more volatility in the daily movement. But when you look through what is on the equity market, you can effectively construct any form of diversification you want. I mean, we mentioned before there's 2,000 companies on the ASX. If you want to own exposure, and I don't, but if you wanted to own exposure to, say, the gold price right now, you can do that by owning gold, or you can do that through owning companies on the ASX that are exposed to the gold price. So from that point of view, I don't think the asset class matters per se. I think what matters is what you own within the asset class. And I would argue that, just as in any market, there's probably one or two of the best of everything. There's one or two best retailers, there's one or two best miners, there's one or two best healthcare companies. If you own the one or two best in any market in the world, you're going to do very well. If you own the fifth or sixth best in order to tick the box around some form of holding, the odds are you're going to get the fifth or sixth best return. So it's just that question of how do you construct your portfolio to make sure you're owning the best companies exposed to each sector, and you're not all eggs in one basket and you've gone down the chain into the seventh and eighth and ninth best asset.
Mm-hmm. How do you ensure your clients stay in high quality equity assets, and what are they interested in right now?
Yeah, I mean, look, to touch on your point, Andrew, I think there's plenty of opportunities on the ASX, and you can access that really easily through ETFs. There's active managed funds, and I would sort of say that when you're choosing some of those things, you are choosing different asset classes, that not just Australian equities. So I think it does come down to certainly an individual's ability to be able to do that analysis around a direct stock portfolio and putting that portfolio together. I would say that most retail investors would struggle to do that to the depth of analysis that Andrew would be doing for what he does and his specific offering. So we're not advising clients on direct equities, but we would take a view in terms of an allocation for Australian equities in a portfolio. We have a bias towards Australian equities because of the tax advantage of franking credits, and we can do that. Not necessarily public offer funds can do that, but I guess what I'm saying is that we can take that position in terms of this is what we want exposure to Australian shares. We're not necessarily going to be wanting to make the decisions between what top 20 we're investing in. We know that sort of market is going to behave like the market. Where we might look to active management, for example, would be, say, in those sort of small to mid-cap segments of the market where you can have a manager that does the research and has that information advantage. And I do think that information advantage is becoming more difficult these days, particularly with what Index is doing and the flow of information to the market. I also think AI is going to accelerate that trend as well, and it is making the markets become a lot dumber than what they used to be, and it's getting away from the whole idea of allocating capital efficiently. So I think public markets generally do have some of these long-term issues that I think will be exacerbated by AI. And I would think that a lot of the great opportunities now and going forward are outside of the public markets.
Well, this is another debate for another day. Can I just be a bit cheeky and ask you, because we hear a lot now about the rotation that's happening between a lot of these high growth companies into value companies. Is that something that is front of mind for you in dealing with clients?
Look, it is. And we use ETFs that can get exposure to a particular factor of the market, and quality over the last 10 years has been the outperforming factor. what we saw last year is quality underperformed and values come into shine. And it's been a long time since value has been able to take that position. I suppose looking behind the drivers of that, there is, I think, a little bit of an impetus to lean more into value. If you look at some of the disruption that AI is going to cause, it makes trying to predict the cash flows of those higher growth or those technology businesses that much more difficult, and so that much more uncertain. So the risk premium has to increase for that, and the price has to come down. Going for businesses that are generating cash flow, very established markets that may not be as subject to that disruption and be a little bit more certain. I think there's certainly a case for that. But AI is certainly going to create opportunities across all sectors, and I think you need to be cognizant of your style exposure.
Well, it's good to be fashionable at the very least.
Although rare
value
position.
is always in fashion.
Yeah, look, again, I think it's a question of what do you define the term value as? And we talked about that in our first episode. If you're using, or if we as a market are using value to mean the Benjamin Graham balance sheet, last puff of the cigar, then yeah, it goes in and out of fashion as fear and greed comes in and out of fashion in the market, right? You know, that's a very fearful position. It was built in the 1920s and 30s because of the Great Depression. But if what we mean by value is just buying an asset for less than it's going to deliver us in the long run, then I think value is always in fashion. It's a question of how do you use the term. I think what's really interesting with that is that, you know, we're going through a little bit of a fear period in the market at the moment now. That's pretty clear. And I'm constantly reminded of that lovely quote of that money doesn't buy happiness, but it sure solves a lot of problems. The reality is that companies that make a profit, assets that perform, in the end will ride out any changes in market sentiment pretty easily because there's cash coming in every day that can be used to fix any problems that develop. Companies, on the other hand, that are constantly capital raising or heavily indebted, they are the ones who will fall and fall heavily when markets fall, because eventually that tap of new money gets turned off. Eventually the investors or the bank turn around and say, well, you're never going to pay me back. There's no more money coming. And if you look at the big crashes in share prices that have sort of happened, they've happened in two key areas recently. The first one is just high PE companies, companies where market sentiment ran away from any form of fundamental value. You know, if the market average long-term is 20 times for earnings, companies trading on 100 times plus were always going to find that, like Icarus, they had flown too close to the sun. And the second group of companies are these, what I would have called market darling, high growth companies that I think you called it, Rob, where they actually don't make money. They have the promise of money in the future, but at the moment they're not making any profits. And at some point, backers, whether those backers are shareholders who want a return or those backers are lenders who want cash flow, they're going to turn around and say, show me the money. And I think Nassim Taleb said it last night, those will be the ones that go broke.
Mm-hmm. Well, look, I've got us off-piste once again. Rob Gilmore, Wealth Simplicity, thank you so much for joining the conversation.
Great to chat.
I really appreciate it. Now we're going to take a bit of a break and get to a viewer questions because, of course, you asked. Welcome back. Let's get to our viewer question. It is, if I've decided that I'm definitely going to buy or sell a stock in the near future for valuation reasons, how should I decide when exactly to pull the trigger? And this is a question coming to us from Krish. Andrew Coleman, Teaminvest, is here with me in studio to answer that question. You've got a bit of a giggle going on.
Yeah, I think it's the question that everyone wishes we knew an answer to.
Yeah.
I think the reality is, and we've talked about this a lot, but I think we overthink things as investors. So my comment would be, if you've decided that you want to buy a company, you've done all your analysis and you think it's a wonderful company, and Mr. Market is offering it to you at a price that you consider reasonable, then I think any form of extra thinking that you're doing around trying to time the market better is probably not a good use of your time. You know, the reality is we cannot predict share price movements in the short term. There are thousands of economic papers that have proved that. So from that point of view, trying to predict if tomorrow will be a better price than today is an unfortunately game of guesswork. So I think if you've decided, Krish, that you want to own the stock and it's at what you consider a reasonable price, then put it in with a limit order of what you're prepared to pay and own the thing. And I would say the same goes in reverse for selling. So if you've decided that the company is either a company you no longer want to own, or alternatively that Mr. Market is so exuberant about it that you think, well, even though it's a wonderful company at that price, I'd rather have the cash, then I think you're better off selling then rather than holding on for that little bit of extra gold down the line. And my comment behind that, I think, is really borne out by reality. You know, most of us tend to find when we've been investing for a long time, and I'm sure you feel the same at home, that our biggest problems have always come from opportunity cost. So opportunity cost is that idea of when we've decided to do something, we decide not to in order to chase something else. In other words, it's the foregone gains we would have had if we'd made our decision quicker. And almost always when I hear from investors and from our fellow members, that's the one they talk about. You know, I decided I was going to sell corporate travel when Jamie Ferris said something, and I didn't because I held on for a better price, and now what's happened? Or alternatively, you know, when Technology One was at $8 a share, it looked like such a screaming buy, but I thought I'd put my order in cheekily at $7.50 and I missed out. You know, those are in the end usually the things as a value investor that burn you the most. And the reason is simply because you're avoiding the stuff that burns the average person. The stuff that burns the average person is you buy a dog. Well, we're not buying dogs. So from that point of view, whether we own the unicorn today or tomorrow, it's still a unicorn.
I've an idea for a future episode. How about dogs and unicorns? Or let's say unicorns and dogs.
Done.
All right. Andrew Coleman, Teaminvest, always a pleasure. Thank you so much. Please do keep your questions coming in. We've had the strap up on the bottom of the screen. It's wealthy@ausbiz.com.au. Thanks for watching Wealthy and Wise for this week. We'll see you next week.
We hope you found today's discussion insightful and inspiring. If you know anyone else who could benefit from hearing this episode, please hit the share button and pass it on. If you'd like to learn more about Teaminvest or our unique investment approach, visit us at teaminvest.com.au. And please don't forget to subscribe to the podcast for more episodes. Until next time, stay informed, stay invested, and keep building wealth.